Coeur Mining just posted a record $1.09 billion in revenue and $388 million in free cash flow, and cut guidance at both new Canadian mines in the same breath. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Coeur Mining gets graded and traded. So on the headline, revenue came in 17.6% below estimates. But here's the thing. The reported number was still a record $1.09 billion, up 126% year over year. The miss is against a very hot expectations bar, not against last year. And on EPS, they came in 63.6% below estimates at 12 cents a share. But that's got a big asterisk on it. A $140 million non-cash acquisition accounting charge tied to Rainy River's stockpile inventory hit the P&L this quarter. Strip that out and the clean operational EPS was closer to 22 cents. So on the beat itself. And remember, the letter grade is computed off the raw surprise sizes. This earns an F, even accounting for the acquisition noise, missing revenue by 17% and EPS by 63% against the street is a real miss on the tape, and that's what gets graded here. And on consistency, this lands at a C. The company has been building its track record, but this print breaks the recent rhythm of clean beats, especially with the guidance revisions layered on top. Let's talk about the positives from the report. Revenue hit an all-time high of $1.09 billion, up 126% from a year ago. That's the first full quarter with the New Gold acquisition contributing, plus record gold production of 163,000 ounces. On absolute financials, this was a genuinely record quarter. Free cash flow was a record $388 million, up 165% year over year, and the cash balance nearly doubled since year-end to $1.05 billion. That's roughly 10 times what they had in the same quarter last year. This company is generating serious cash right now. They're already returning it to shareholders, too. $121 million in buybacks through the end of July, which is about 6.7 million shares repurchased. Plus, they paid their first ever semi-annual dividend in June. Management is putting money back in shareholders' pockets in real time. And even with all the noise, the full year 2026 targets are still intact. $2.3 billion in adjusted EBITDA versus $1 billion in 2025 and $1.5 billion in free cash flow. If they hit that, this is a completely different company than it was a year ago. On the operations side, the 5 legacy mines are all reaffirmed at prior guidance. Rochester hit record crusher throughput of 6.8 million tons, up 15% quarter over quarter, and Wharf nearly doubled its gold production. The core business is executing well. The issues are isolated to the 2 newly acquired Canadian mines. So on profitability, I'm giving this a B. The adjusted EBITDA and free cash flow numbers are the cleanest read on underlying performance, and both were records. The optical gap numbers are noisy because of the acquisition accounting, but the underlying earnings power is real. Now let's talk about the negatives from the report. Both of the new Canadian mines had their partial year guidance cut. Rainy River gold guidance came down from 230 to 275,000 ounces, to 190 to 230,000. New Afton also got trimmed. The underground ramp-up and the C-Zone cave development are both moving slower than the acquisition thesis assumed. Rainy River capex guidance nearly doubled, from $81 to $101 million, up to $150 to $170 million. Some of that is a reclassification of stripping costs from expense to capital, but there's also $25 million of genuinely added underground development spending. Regardless of the accounting, that's real cash going out the door. Realized metals. prices softened materially into June. Gold was down 6% quarter over quarter to $4,140 an ounce, and silver was down 14% to $71 an ounce. June alone was the weakest of the year, and management is now using lower price assumptions for the back half of 2026. The share count situation is worth flagging too. Diluted shares ballooned from 699 million in the first quarter to 1,034 million now because of the new gold acquisition. That's structural dilution to every per share metric going forward, and it's why GAAP net income dropping from 24 cents to 12 cents feels sharper than the underlying business change. And even stripping out the one-time acquisition accounting charge, the underlying gold cost per ounce came in around $1,608, still meaningfully higher than the legacy operations were running at. So the higher cost profile of the new Canadian mines is a real structural shift, not just an optical noise issue. On guidance, this lands at a D+. Cutting the outlook at both new mines while nearly doubling capex at Rainy River is a real negative signal, even though the full-year cash and EBITDA targets held together. When you cut production and raise spending in the same release, that gets graded down. And on red flags, I'm at a C. The ramp delays and the softening metals prices are legitimate concerns going into the back half. This isn't a broken thesis, but the near-term path has real chop in it that wasn't priced into the pre-print bull case. Putting it all together, this print earns a C- from me. The absolute financials were genuinely record. $1.09 billion in revenue, $388 million in free cash flow, a cash balance approaching $1 billion, and real capital returns already flowing to shareholders. But the story that matters is the guidance cuts at both newly acquired Canadian mines, plus softer metals prices heading into the back half. The bull case that the new gold acquisition transforms Coeur into a diversified cash machine is directionally validated, but the execution timeline just slipped, and the whole full-year target now depends on a sharply back-weighted fourth quarter ramp that already stumbled once. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. For me, I'm not in a rush here. I want to give this 2 to 4 weeks and watch whether metals prices actually stabilize before I put money in. I'm also watching the July mining rates at Rainy River and New Afton to see if that strength holds into August, because the guidance cuts at those new mines mean real headline risk for another revision. So if I'm entering with a cash secured put, I want to sell it on a pullback, tied to more gold or silver softness. I'm not chasing this into strength. My plan is simple: wait for the pullback and don't chase. If I'm selling cash-secured puts here, I'm going with wider out-of-the-money strikes that can survive a 10 to 15% correction if metals weaken more or if the new Afton C-zone ramp slips again. The guidance revision itself tells me management is walking expectations down, and a second miss would hit sentiment really hard, so I'm respecting that. I'd only justify closer strikes if I genuinely want to be assigned at those levels, and the $1.05 billion cash balance plus the active buyback do give me real fundamental floor support. For me, that means wider strikes and respect the risk. If I own shares here, I'm holding. Record adjusted EBITDA, $388 million in free cash flow, $121 million in buybacks already done, and the first dividend all validate why I own it. The full year 2026 targets of $2.3 billion EBITDA and $1.5 billion free cash flow are still intact even with the guidance trims, so my thesis hasn't broken. I'd only consider trimming if I'm overweight and want to move money elsewhere, because the second half backweighting means the payoff for holding through fourth quarter execution is really lopsided to the upside if the ramp lands. So for me, hold. The thesis is still intact. If these were my covered calls and my strikes get threatened, I'm rolling out instead of letting the shares go. The record cash generation and the enhanced capital return program tell me not to give up shares at preprint strike levels. So if my strike is in trouble, I'm rolling it out in time to keep my shares and stay in the position. If I'm writing new calls, I'm pricing in a fourth quarter catalyst with the C-Zone Step Up and Rainy River Underground, and I'm using wider out-of-the-money strikes instead of grabbing near-term premium. For me, roll out and don't get called away. If I'm holding leaps on this one, I'm sitting tight. The bigger picture story of a diversified North American precious metals producer with a $2 billion year-end cash target and active capital returns is directionally validated even with the ramp delays. I'm not rolling up until fourth quarter execution is actually confirmed. If the C-Zone and Rainy River Underground hit their year-end targets, the market repricing this stock higher is still ahead of me. Rolling up too early would burn my optionality on the exact catalyst that drives my leaps thesis in the first place, and I don't want to give that up. So for me, hold the leaps and wait for the fourth quarter. If I'm underwater or looking to add, this release validates my long-term thesis with the record cash, active buybacks, the new dividend, and the 2026 EBITDA target of $2.3 billion versus $1 billion in 2025. But it also invalidates the specific short-term ramp timeline that probably drove entries near recent highs, so I'm honest about that. For me, averaging down makes sense on more weakness tied to metals, price softness, not on strength. The fundamentals support the name, but the near-term path has more chop than the preprint bull case implied. So my rule here is add on weakness, not strength. Bottom line, this print earns a C- from me. The cash generation and capital returns are the real story, but the guidance cuts at the new Canadian mines and softening metals prices mean the next few months have more chop than the preprint thesis assumed. The fourth quarter ramp at New Afton and Rainy River is the single most important thing to watch from here. Thanks for watching, and I'll see you on the next one.